and where's it going to be geographically, and what's it going to do to the rest of the system. And one of the places which is expanding very rapidly right now is, of course, China. But there are many signs of overproduction in China, overaccumulation in China, and there are serious kind of questions about whether China can maintain its growth path. So the geographical dimensions of this are, to me, really very, very important. But as I also mentioned, we also have to deal with the temporal dimensions, and the temporal dimensions are indeed much better handled by Marx's theory of crisis and crisis formation. And in order to write this book, I had, in a way, to try to rewrite some ideas about what Marx's theory of crisis formation is. And one of the things I have to constantly tell my students, and I'll also tell you, is you've got to be very careful about putting too much faith in Marx's one-liners. When Marx kind of says the falling rate of profit theory is the most important law or something like that, and people give that to me as a one-liner and say, why aren't you emphasizing that? And I say, well, that was a one-liner. Elsewhere he said something like, well, it's not really a law, it's a tendency, or it's a law of a tendency, or it's a tendency of a law. And then he kind of says, there's a lot of counteracting influences, and when you count them all up from everywhere, you find actually there's so many counteracting instances, you wonder whether the law will ever work at all. So you have to look at what Marx does, rather than what those one-liners. And in looking at what he does, and this is, if you like, one of the things that's come out of teaching Capital all these years, I'm very familiar what he does. And the Marx project, which I now kind of think of as putting volume 1 lectures online, we're now gearing up to put the volume 2 lectures online. But in doing that, then people can see what he does, and as you see what he does, you come out with a rather different interpretation than you come out with one-liners. And it's this interpretation, it seems to me, which is absolutely crucial. For example, falling rate of profit argument it's not entirely wrong, but it's just one aspect. But here we have a crisis in which clearly we can't talk about its dynamics without talking about the financial system. And the falling rate of profit says absolutely nothing about the financial system. Secondly, we can't talk about this crisis without talking about consumerism. If 70% of the growth dynamic right now in American economy is consumer sentiment and consumerism, then you need actually to get both finance and consumerism into the picture in order to talk about the formation of this crisis. And to do that, you need then to look at how Marx handles issues of this kind. Now, one of the ways in which I think he handles this is to sort of lay out, and it is particularly a volume 2 analysis rather than a volume 1 or volume 3 analysis, a volume 2 analysis which is about the flow of capital. And Marx talks about a system in which capital is really defined by money being used to make more money. And there are various ways you can make more money. I mean, there are all kinds of illegal ways you can do it, and we've seen a lot of that, of course, through what I call accumulation by dispossession, through all these foreclosures and all the rest of it, a lot of illegal practices and so on. But a healthy capitalist economy is presumably one where you can, make more money legally by going through the market. And so what Marx does is to set up a way you can do that. Now, you can do it a variety of ways. I mean, you can just have money, you can lend it out for interest, you can get land and you can rent the land out, or property, or you can get assets, or you can rent them out, or something like that, or you can gain intellectual property rights and charge royalties for their utilization, those kinds of things. But the way Marx sets up is that, well, a healthy capitalist economy is one where it's going to be expanding through the exploitation of living labor in production. And the system he sets up is really very simple. Money is taken into the marketplace where it buys two kinds of commodities, labor power and means of production. Those two commodities are then brought together in a labor process under given conditions of organizational power and also given technologies. And that labor process then produces a commodity which is sold in the market for more money than you started out with. I mean, that's the standard, if you like, sort of argument. Now, if you look at that system, there are a number of things you can say about it. The first thing is its continuity is terribly important. If it doesn't keep on going, flowing very far, then there's a crisis. Any blockage in that system is a crisis. And Marx, in many parts in the Grundrisse and also in Volume 2 of Capital, says these blockages are points of crisis, potential points of crisis. So the continuity is fundamental. And you can see that actually in all sorts of ways. I mean, you look at the impact, for instance, of 9/11. I mean, I was living in New York. All movement stopped. The flow stopped. Nothing seemed to be happening. And within 4 or 5 days, Giuliani was coming on television and saying, for God's sake, get your credit cards out and get back in shopping. You know, and go around Broadway, there are all these shows and there are empty seats and the restaurants around. Go on out and have a good time, you know. Get the economy moving again. And Bush came on television in an collective ad for the airlines saying, for God's sake, get back and start flying. So and you remember when the Icelandic bankers took revenge by erupting a volcano, you know, and what impact that had upon I mean, billions were lost, right, over all of that. So you know, so the continuity is terribly important. The second thing is the system has to expand. That it has to grow. There's more at the end of the day than there was at the beginning of the day. And for certain reasons, there's an interesting point about what do people do with the profit they got at the end of the day? Do they, you know, do they spend it like you and I might do and have a good time? Or are they forced by certain features to reinvest part of it? And the answer is, yeah, they have to reinvest in order to remain capitalist. And I won't go into exactly why. It's a simple story and there's a complicated story about that. But the result of this is that capitalism is about growth. It's always about growth. It always has been. And the data show that since around 1750 or 1780 or whenever, capitalism has grown at the rate of something like 2.25% per annum, okay, at a compound rate. Compound rate, that's a crucial thing. It's a compound rate of growth. Now, actually, if you go to the financial press right now, people kind of will go on and kind of say, well, things are pretty sluggish if they're 2%. You know, this evening I saw something where it said, well, economists have downgraded their forecast of the growth of the US economy. It's down to around 2.7%. It was 3.2%, and this is getting bad when it's 2.7%. So there seems to be a minimum growth rate of around 3%. Which is acceptable, and people feel happy if you're growing at 4 or 5%. And in the history of capitalism, there have been periods when it's been growing in aggregate at 4 or 5%, as it did in the 1950s and 1960s. Other times when it's been 0%, as in the 1930s and as it was in 2008. So there's lots of differences, but you know, 3% compound growth is, if you like, a basic kind of rule which seems to govern the dynamics of capitalism. Now, 3% compound growth has certain implications. When you're talking about 3% compound growth, when capital was constituted by what was going on in Manchester and Birmingham and a few other hot spots in, say, 1750 or 1780, that's one thing. But you're now talking about compound growth on everything that's going on in Europe and North America and Japan. Most of what's now going on in China, a lot of what's going on in India and Indonesia and Eastern Europe and Russia, you know, Latin America and all the rest of it. I mean, 3% compound growth on all of that starts to look more and more stressful, more and more difficult. And actually, if you sort of say to yourself, can we have 3% compound growth forever? You start to say, well, you know, no, that just doesn't make sense. And in monetary terms, the global economy right now is around $55 trillion. 3% compound growth means that you've got to start thinking about finding new investment opportunities for something like $1.5 trillion right now, going up to $3 trillion by the time you get to sort of 2030 or so. So you're really looking at having to find profitable investment opportunities for more and more money. And there is what I call in the book a capital surplus absorption problem. How are you going to actually find places to put that are profitable? And one of the arguments I would make is if you look back over the last 30 years, you would see actually some very interesting signs that capital has been having real difficulty in doing this in productive kinds of and meaningful ways. So you start to get, you know, investment in assets, and so you get asset bubbles, and so you start to create fictitious markets in which all kinds of money can go in and start to, you know, and every time something comes along, somebody uses it as an opportunity to create a fictitious market. I mean, Al Gore's great gift to humanity was to say, well, okay, there's a climate change problem. How do we solve it? We create a market in carbon trading futures. What? Yeah, I mean, it has no impact whatsoever on the environment, but it's a great new market, and of course you can start to invest in derivatives of the market and futures in the market. So, and it's already quite strong. The futures, carbon trading futures market in Europe is already quite strong, quite big. It'll soon become huge, and these markets start to circulate vast amounts of money. For instance, in 2006. If you add up all the currency swaps and the credit derivatives and all those kinds of things, the amount of money circulating in those markets was over $600 trillion. $600 trillion in a world economy which is only producing $55 trillion of goods and services. And you know, and I would occasionally meet one of these bankers in one of these bars in Manhattan, and I kind of say, you know, how does that all compute, you know? And they kind of say, oh, well, don't worry. There's only about 10% liabilities in that $600 trillion. And I say, oh, is that also $60 trillion of liabilities against $55 trillion of total output? Yeah, well, it really is. Very comforting, thanks very much. And so you have these, but the thing is that people are extracting real wealth out of those markets. I mean, 2 years ago, about 5 of the hedge fund people drew $3 billion out of the market. You know, George Soros was one of them, John Paulson was another. And $3 billion personal remuneration in 1 year was extracted from playing in those markets. And this is real social power, and we can of course see how that real social power is being used politically right now in the current election. You can absolutely see how it is absolutely swamping the electoral process, and of course it's buying political power, buying political influence, and all the rest of it. So over the last few years we've seen these sorts of markets forming, and we've seen all of these asset bubbles jumping up. You know, I mean, for a while it was the dot-com bubble, and then when that crashed, it became the property bubble. Now, the thing about asset markets is they have a Ponzi character without a Bernie Madoff at the top. I mean, if I invest in stocks and shares, the stock market goes up a little bit, and other people say, oh, well, it looks like the market's going up, I'll invest. And so somebody else invests, and they go up further, and then we keep on going. Go like this. The same thing happens in the property market. You know, I invest in property, and property goes up, and it goes up and up and up and up, until at some point or other it goes, as they always do, sort of pop. So what we've seen, I think, is a real difficulty of absorbing the surplus in meaningful ways, and this comes out in other peculiar instances. For example, in the world of consumption, you know, one of the things that Marx does a lot is to emphasize, particularly in production, is the notion of turnover time. He doesn't really emphasize the turnover time in the world of consumption, but I think actually that's been a very, very important variable which has to be paid attention to. For example, I'm still using my grandmother's knives and forks from about 1850. Now, if capital made things like that all of the time, where would its market be? So capital over time has specialized in making things that break down and fall apart and don't last, and also, of course, innovates in such a way as to render almost instantaneously obsolescent whatever it is you have. I mean, how many times have you changed your computer in the last, 10 years? And you get your iPods and your iPads, and and they you drop them and they fall, So there's an incredible kind of speed up and turnover in consumption, to the point where actually one of the things that suddenly struck me is really very interesting point, is that Guy Debord wrote The Society of the Spectacle back in 1967, and one of the points there is, this is becoming a society of spectacle. But the great thing about a spectacle is it's instantaneously consumed. So actually urban life has been built more and more around the notion of the spectacle. And therefore we're constantly involved in more and more, caught up in the spectacle, even to the point where we get so absorbed in it that we become the spectacle. I mean, you only got to look what's going on Facebook and seeing everybody's kind of becoming a spectacle to everybody else. So the spectacle becomes very, very significant. And you look at something like, you say, look, for example, at the amount of money and